All right, let's dive into a fascinating and pretty urgent theory about what's happening in the silver market. The argument we're breaking down today is that there's a high-stakes 9-day showdown on the horizon, a period that could, well, change everything. We're going to walk through the whole case, step by step. So, the source material for this whole thing kicks off with a really provocative question. Is your wealth just evaporating? The core idea is pretty simple. If your money isn't growing faster than new money is being printed, you're actually losing your ability to buy stuff. This really sets the stage for a critical discussion about what real value even is anymore. And this quote, it just perfectly captures the entire argument. What might look like a roaring, successful stock market could actually just be a symptom of a failing currency. It's not that the companies are suddenly doing better, it's that the measuring stick we use, the dollar itself, is shrinking. And that is a huge difference between price and actual value. Okay, so that brings us to the main event, the core thesis, this very specific 9-day window, from February 15th all the way to the 27th. The argument is that during this short period, the silver market is barreling towards an unprecedented showdown. So here's the setup, the core conflict as the analysis lays it out. China's markets are closed for the New Year holiday. That's the key. The argument is that this gives Western financial institutions a unique, totally uninterrupted window of opportunity to try and force the price of silver down right before a critical delivery deadline. The source frames this whole conflict as this epic battle of titans, Goliath versus Godzilla. And honestly, it's a pretty compelling metaphor for the two massive opposing forces that it claims are in a tug-of-war for control of the global silver market right now. Okay, let's meet the fighters. In this corner, we've got Goliath. That's the COMEX exchange and the big Western banks. Their main weapon? Paper silver contracts. And, as the source points out, they've got decades of experience, well, changing the rules when they need to. And in the other corner, you have Godzilla, China. They control a mind-boggling 70% of the world's refined physical silver, and they are aggressively stockpiling it.
Now, to really understand Goliath's supposed playbook, the source tells us to look at history. The argument is simple. Messing with the market isn't new. There is a very clear precedent for changing the rules of the game when the house is about to lose.
The classic example here is the Hunt brothers' attempt to squeeze the silver market back in the late 70s. I mean, these guys bought so much physical silver that they sent the price from $6 an ounce to nearly 50. So what happened? The COMEX exchange stepped in, created a brand new rule out of thin air, and within a few weeks, the price completely collapsed, bankrupting the Hunts in the process. So the really crucial part is how they did it. This silver rule number 7, it specifically targeted the buyers. It banned them from using leverage, but, and this is the key, it let the sellers keep using it. This completely choked off all the buying pressure and just let the selling pressure run wild. It effectively broke the market's back.
And hey, if you're thinking, okay, but that was ancient history, while the source points to a much more recent example. Just back in 2020, JP Morgan paid a massive $920 million fine for what the Department of Justice called a huge scheme to manipulate the precious metals markets.
This all leads us to the central battlefield in this whole conflict. The fundamental, massive difference between paper silver, futures contracts, promises of metal, and the actual physical silver bars sitting in a vault. And believe me, that distinction is everything.
So, to really get what's going on, we need to know the lingo. In the COMEX vaults, there are two types of silver. Registered silver is the stuff that's actually for sale, ready to be delivered on a contract. Then there's eligible silver. That's just metal being stored there. It's not for sale unless its owner specifically decides to make it available.
And this chart, wow, this really visualizes the core problem that our source is pointing to. You've got paper contracts out there claiming 400 million ounces of silver, but there are only 100 million ounces of registered, deliverable silver sitting in the vaults. That's a 4-to-1 ratio of paper promises to actual physical reality.
And it looks like people are starting to call the exchange's bluff. This past January, supposedly, saw 7 times the normal amount of physical silver get delivered out of the vaults. Now, that's not just speculation. That is a massive surge in demand for the real metal over the paper promise. So how does this all build toward that critical timeline? Well, with the vaults draining, the argument is that the Western banks need a window, some breathing room to get control back. And China's holiday? It provides the absolute perfect opportunity. Okay, let's look at this countdown. February 15th, the Shanghai exchange shuts down.
Then, U.S. markets are closed on the 17th. That means the real action allegedly kicks off on Tuesday the 18th. China reopens on the 24th, just 3 days before the really critical deadline, February 27th, which is first notice day for the March delivery contracts.
So here it is, the alleged 4-step playbook. Step 1, China goes offline. Step 2, the banks can flood the market with paper shorts. Step 3, they raise margin requirements, just like they did in 1980, to force anyone with leverage to sell. The whole goal is to crash the paper price and basically scare contract holders into just taking cash instead of demanding the physical metal.
But, and this is important, this is not a one-sided fight. The source points out that China has already made defensive moves. They've raised margin requirements specifically for foreign short sellers on their own exchanges. They're trying to build a fortress around their market and make it crazy expensive for outsiders to attack the price while they're gone.
All of this, every single move, is building to the final act of this showdown, that February 27th deadline. That's the day when holders of March futures contracts have to say, do I want the physical metal or do I want the cash? This is where the paper promises slam right into physical reality.
And here's the fatal flaw in this whole alleged short-term strategy. This quote from the source just brilliantly illustrates the problem. Smashing the paper price might work for a week, sure, but it makes physical silver cheaper for industrial buyers like China to just scoop up, which actually speeds up the drain on the vaults. It's a short-term fix that makes the long-term problem much, much worse.
So what's the takeaway here? Well, the source says to watch for extreme volatility. Any paper price crash could actually be a buying opportunity for physical metal. The key indicator to watch is the daily COMEX vault data to see how inventory is changing. And finally, all eyes are on February 27th to see just how many people demand the real thing.
And this just perfectly illustrates the ultimate stakes. In 2022, the London Metal Exchange literally canceled legitimate trades just to prevent the collapse of a single large nickel trader. So the source asks the critical question, can you really change the rules of the game like that when your counterparty isn't just one company, but a global superpower?
Which leaves us with this final, really provocative question. If the whole system of paper promises breaks down, and the exchange that's supposed to set the price can no longer deliver the actual asset, who gets to decide what that asset is truly worth? The entire price discovery mechanism itself is called into question. And that, right there, is a scenario with profound implications for markets everywhere.